Imagine you're sound asleep when your phone starts buzzing at 5:47 a.m. Not an alarm. Alerts. Dozens of them. A major conflict has just broken out overnight. Now, here's a question worth sitting with. In that exact moment, what do most people do first? They don't call their parents. They don't fill up their gas tank. They don't even make coffee. They open their investment accounts. Think about how strange that is. The world is on fire and humanity's first instinct is to stare at a pie chart. That reaction isn't stupidity. It's financial anxiety, doing what anxiety always does, hijacking your rational brain and replacing it with urgency. And urgency, when it comes to money, is almost always expensive. But here's what almost nobody talks about in those chaotic early hours. While millions of people are frantically hitting the sell button, feeling responsible, feeling smart, feeling like they're finally taking control, a much smaller group of people is doing something that looks borderline insane from the outside. They're buying, not blindly, not recklessly, but deliberately, methodically, and in a very specific sequence built on one thing most people skip: actually studying what markets do during wars. And spoiler, it's not what the television wants you to believe. Before we get into any of that, though, we need to name the elephant in the room. There is a group of people who benefit enormously every time geopolitical fear spikes. It's not short sellers. It's not foreign adversaries. It's the financial media. And again, not as some shadowy conspiracy, just as pure, transparent business logic. Here's how the machine works. Crisis breaks. Viewership spikes. Advertisers pay more for panicked eyeballs than calm ones. The segment producer's job is not to inform you. Their job is to keep you watching. And nothing keeps people watching longer than the feeling that everything could collapse, and you might be the only one who doesn't know what to do about it. Your anxiety is the inventory they sell to sponsors. So, when markets drop 2% after a tense headline, and the cheerin' screams, "Global meltdown continues," understand the translation. A 2% drop is not a meltdown. It's a mildly bad afternoon. But markets slightly lower amid manageable volatility doesn't spike engagement. Terror does. So they find the most doom-forward analyst in their contact list, give him 17 minutes of airtime to speculate about worst-case scenarios, then cut to a commercial for a brokerage platform that will gladly process your stress trade for a small commission. The host gets paid. The platform gets paid. The advertiser gets paid. The one person absorbing the actual financial damage? The person watching from their couch at 6:30 in the morning. Let's make this personal. Meet two people, Marcus and Elena. Both have $50,000 in diversified index funds. Both wake up to the same breaking news. Both see the same red numbers bleeding across their screens. Marcus turns on the TV. The coverage is relentless. Every panel sounds more alarming than the last. Words like unprecedented and historic collapse keep appearing. By mid-morning, Marcus has convinced himself that this time really is different. He sells everything, locks in the loss, moves to cash, breathes a temporary sigh of relief. Elena sees the same news, but she does something different. She spends 10 minutes reading a single piece of historical data, something she'd actually looked up months earlier and saved for exactly this kind of moment. That data point: in the decades since World War II, the S&P 500 has recovered from every major geopolitical shock in roughly 2 months on average. Every single one. She puts her phone face down, gets dressed, goes to work. What happens to their money from that moment forward is the entire story here. And the gap that opens between them is not small. Here is the statistic that almost never leads a broadcast. Markets do not die during wars. They flinch. They pull back, sometimes dramatically, and then, historically, they recover. Over the past 100 years, equities have survived 2 world wars, multiple regional conflicts, the Cold War nuclear standoff, the oil embargo, the September 11th attacks, a global pandemic, and more financial crises than anyone wants to count. And through all of it, the long arc of the market bends upward. Why? Because war, as brutal and devastating as it is on a human level, is also one of the largest economic acceleration events in modern history. The moment a government mobilizes for conflict, the spending faucet opens wide. Defense contracts get issued overnight. Supply chains get rerouted, rebuilt, and reinforced. Fuel, food, logistics, cybersecurity, satellite systems, medical infrastructure. Thousands of companies suddenly have the most reliable customer in existence. A government with an open checkbook. Those companies are publicly traded. Revenue flows in. Earnings rise. Eventually, the stock prices follow. This is why the investors who historically suffered the most during crises weren't the ones who held steady. They were the ones who sold and waited, because waiting for it to feel safe again usually means sitting in cash while inflation silently chips away at your purchasing power and then re-entering the market after most of the recovery has already happened. That's exactly what happened to Marcus. He moved to cash. The headlines stayed scary, so getting back in never felt like the right moment. Weeks passed, then months. When he finally reinvested, the sectors that had surged were already priced in. He missed the climb. He didn't protect himself from the crisis. He just guaranteed a worse outcome from it. Elena, meanwhile, wasn't just passive. She had a framework she'd built in advance. A clear, logical sequence of moves designed specifically for moments like this. Not reactive, pre-decided. And the order of that framework matters, because each layer reinforces the next. The first layer is cash flow security. Before anything else, Elena made sure she had 6 to 12 months of living expenses available and accessible. Most of it lived in a high-yield savings account and a government money market fund. But she also had a few $1,000s in physical cash at home. That sounds extreme until you remember that modern geopolitical conflict increasingly involves cyber warfare. Payment systems, banking infrastructure, and ATM networks can be disrupted without a single shot being fired. Physical cash for short-term needs isn't paranoia. It's just a backup generator for your finances. But, and this is critical, this is also where the cash strategy ends. Because hoarding cash during wartime is, historically, one of the most quietly devastating financial mistakes you can make. Governments at war borrow and spend at enormous scale. That drives inflation. Inflation erodes the real value of idle money. A giant pile of cash in a crisis isn't safety, it's a slow bleed. The second layer is gold. Not because gold is magic, not because the world is ending, but because gold has served as a reliable store of value during currency uncertainty for centuries. The smartest time to own gold is before the panic starts, not after the headlines spike, which is when most people rush in and pay a premium for it. Elena already had a position, about 10 to 15% of her investable assets, held in low-fee ETFs like IEU alongside a small amount of physical coins as a tangible fallback. There's also a structural driver that doesn't get enough attention. Central banks globally have been aggressively increasing their gold reserves over the past several years, diversifying away from dollar dependence. That sustained institutional demand creates a floor that retail fear alone never could. The third layer is defense. It feels uncomfortable to say, but defense companies tend to do very well when the world gets less stable. Major contractors generate backlog orders that can stretch for years, sometimes decades, and those contracts rarely get canceled. An ETF like XAR provides exposure across multiple companies in the sector without betting everything on a single name. The uncomfortable reality is that defense spending rises during uncertain geopolitical periods, and markets price that in. The fourth layer is energy. Nearly every significant conflict in modern history has pressured global energy supply. Shipping lanes become unpredictable. Oil-producing regions become unstable. Transportation costs spike. When supply contracts, while demand holds steady, energy companies profit, sometimes dramatically. During some of the worst recent market downturns, energy stocks were among the only sectors posting meaningful gains. ETFs like XLE provide broad exposure to major producers who have historically benefited from exactly these dynamics. The fifth layer is consumer staples, which sounds boring by design, because boring is exactly the point. When economies contract, people cancel vacations. They put off buying cars. They stop renovating kitchens. But they still need soap. They still need medicine. They still need food on the table. The companies making those everyday essentials become essentially recession-resistant anchors in a portfolio. An ETF like XLP holds a basket of those businesses. Nobody mentions it at dinner parties, but it tends to look very good when everything else is struggling. The sixth layer is inflation protection. Here's one of the most counterintuitive lessons from wartime financial history. Traditional long-term government bonds often get crushed during periods of heavy government borrowing and rising prices. They're fixed payments by less and less in real terms as inflation climbs. Treasury inflation-protected securities, TIPS, work differently. Their principal value is indexed to inflation, which means their purchasing power is preserved as prices rise. You can access them through ETFs like TIP or directly through Series I savings bonds at the U.S. Treasury. This layer doesn't generate excitement, but it stops inflation from quietly stealing a significant portion of your real returns. And then, the single most important rule in the entire framework: don't touch the index funds. Not a single share. Broad market funds like VTI, VOO, or SPY represent the entire American economy, thousands of companies across every sector, absorbing government spending, innovation, global commerce, and human ingenuity all at once. Selling them during fear almost always means missing the recovery, and missing even a small handful of the best trading days in any given decade can cut your long-term returns dramatically. The math on this is brutal and unambiguous. So, what happened to our two investors? Marcus sold $50,000 in index funds, waited on the sidelines while his cash lost purchasing power, re-entered the market late, paid taxes on gains he liquidated unnecessarily, and missed a significant portion of the rebound. The crisis didn't destroy his wealth. His reaction to the crisis did. Elena stayed invested, kept her automatic contributions running without skipping a beat, strategically added exposure to gold, defense, energy, staples, and inflation protection while others were selling. Years later, the difference between those two portfolios wasn't a rounding error. It was life-changing, and it didn't come from a genius stock tip or perfect market timing. It came from one foundational decision made before the chaos started, knowing in advance exactly what she would and wouldn't do. So picture that morning one more time. It's before sunrise, alerts flooding your screen, red everywhere, every financial channel hosting back-to-back crisis panels. The pressure to do something, anything, is almost physical. One person opens their brokerage app with shaking hands, sells everything, and spends the next 12 months watching the market recover without them, funding the very media machine that scared them into selling in the first place. Another person opens a document they wrote months ago, checks the cash cushion, it's there, reviews the gold position, already held, notes the defense, energy, and staples allocations in place, confirms the index funds are untouched, then closes every app, makes a pot of coffee, and goes about their morning. One of those people builds significant wealth through a global crisis. The other one pays for everyone else to do so. The best investment decision you will ever make isn't a ticker symbol. It's not a market prediction. It's a plan you build in the calm, so that when the storm hits, the decision is already made.